Welcome back to the Daily Crypto Deep Dive. Today, we're exploring one of the most fascinating and quietly developing trends in global finance. The idea that one day soon, governments could begin backing their sovereign debt with Bitcoin. It's a story that blurs the line between monetary policy, crypto adoption, and geopolitical strategy. And for investors, it raises a huge question. If Bitcoin becomes sovereign collateral, what does that mean for your portfolio? And for the price of every other asset in crypto? So, let's set the stage. Around the world, national debt is rising to levels that were once considered unthinkable. Inflation remains stubborn. Central banks are walking a tightrope between credibility and chaos. And while digital assets were born in rebellion against this system, they're now being courted by the very institutions they once aimed to replace. Countries from El Salvador to Bhutan, and even the United States, now hold Bitcoin reserves in one form or another. Some through mining operations, some through confiscations, and others through quiet strategic positioning. But here's where it gets interesting. The next step isn't just holding Bitcoin, it's using it. Using it to secure loans, to collateralize sovereign debt, to back the national balance sheet in the same way gold once did. Imagine a government issuing a bond, not backed by fiat or commodity reserves, but by digital assets held transparently on-chain. A bond with a blockchain address you could verify in real time. It sounds futuristic, but it's closer than most realize. El Salvador, of course, was the first domino. Their volcano bond may have been dismissed as a PR stunt in 2021, but its blueprint is now being studied by financial ministries from Asia to Eastern Europe. Bhutan has quietly mined Bitcoin for years, and now considers it part of its sovereign investment strategy. Kazakhstan has openly floated the idea of creating a crypto reserve fund backed by state-mined Bitcoin. Even the US government, through seized assets from Silk Road and other criminal cases, now holds tens of thousands of Bitcoin. They may not call it a strategic reserve, but that's exactly what it functions as. So how does this move from theory to reality? Let's break down how sovereign collateralization would actually work. Traditional bonds are backed by the credibility of the issuing government. But in markets where credibility has eroded, think Argentina, Turkey, or Nigeria, lenders demand something more tangible. That's where Bitcoin comes in. A government could over-collateralize its debt on-chain. Let's say a nation issues a $1 billion bond, secured by $1.2 billion worth of Bitcoin in escrow. If the government defaults, the smart contract releases the Bitcoin to the bondholders automatically. No IMF negotiations, no international court battles, just code executing collateral in real time. This model could, in theory, reduce borrowing costs for high-risk countries. It would create a new class of hybrid financial instruments, sovereign bonds with crypto yield dynamics. And for Bitcoin, it would be seismic, because for every billion-dollar bond like that, hundreds of millions in Bitcoin would be taken off the market and locked up as collateral. Let's bring this home to portfolios. If that trend catches on, Bitcoin stops being a speculative hedge and becomes a core reserve asset. Demand shifts from retail traders and ETFs to sovereigns, banks, and insurers. And as that happens, volatility falls, liquidity deepens, and Bitcoin's role evolves from digital gold to digital collateral. That's when institutional allocation ramps up. Bloomberg Intelligence's Jamie Coutts recently said, if sovereign entities begin treating Bitcoin as collateral rather than speculation, we could see a generational repricing. The total addressable market moves from $1 trillion to over $20 trillion in global collateral demand. That's a staggering idea. And if even 1% of that materializes, it could double Bitcoin's market cap overnight. But this isn't just a Bitcoin story. Ethereum stands to benefit too. Because the infrastructure for tokenized debt, the smart contracts, the programmable bonds, the transparent ledgers, almost certainly lives on Ethereum. Analysts at VanEck have suggested that if real-world assets like sovereign debt are tokenized at scale, Ethereum could hit $12,000 by 2030 purely from network demand and gas revenue. Chainlink, which provides the Oracle infrastructure that connects off-chain collateral values to on-chain contracts, becomes the bridge that makes all of this possible. In other words, when sovereigns start moving money on-chain, it's not just Bitcoin that wins. It's the entire Web3 stack. But before we get ahead of ourselves, we have to acknowledge the risks. Volatility is the first. Bitcoin can move 10% in a day. That's fine for traders. It's a nightmare for debt managers. A government backing a billion-dollar bond with Bitcoin could see its collateral value drop below its liabilities in 48 hours if the market turns. That's why any serious model includes over-collateralization and dynamic hedging. But those mechanisms bring complexity, and for most central banks, complexity means hesitation. Then there's legal friction. Most constitutions and monetary frameworks don't even have provisions for holding digital assets as state reserves. For example, the European Union's fiscal rules prohibit member states from using non-recognized monetary instruments as sovereign reserves. That alone would make a Bitcoin-backed bond illegal in most of Europe today. So early adopters would likely be countries on the periphery. Frontier markets, nations under sanctions, or resource-rich states looking for financial independence. But here's the kicker. Those are the same countries with the fastest-growing crypto adoption rates. They're also the ones most motivated to escape the dollar system. That's where Bitcoin's neutrality becomes geopolitically valuable. It's not American, it's not Chinese, it's math. Before we go deeper, a quick reminder. If you're holding Bitcoin, Ethereum, or any other crypto asset and you want to keep them safe from hacks, regulations, and black swan events, the smartest move you can make is self-custody. Get yourself a Ledger hardware wallet. It's what the pros use, it's what institutions use, and it's what I personally recommend. All right, let's get back into it. The next question we need to ask is, if governments begin collateralizing with Bitcoin, what happens to the market structure? Well, we get a supply crunch. Roughly 19.7 million Bitcoin have been mined. Around 3 to 4 million are lost forever. That leaves maybe 16 million circulating. Of those, over 70% haven't moved in a year. Now imagine just 5 countries collectively locking up another 500,000 Bitcoin in sovereign vaults. That's more than $30 billion worth at current prices. It's not hard to see what that would do to supply and demand dynamics. Even conservative analysts at Bernstein have said, if sovereigns adopt Bitcoin as a collateral asset, we would expect sustained demand inflows of $50 to $100 billion annually. Their base case? Bitcoin reaching $180,000 by 2028 purely on structural demand. Ethereum, under the same scenario, could see daily transaction fees double and validator yields rise to 9%. And for Chainlink, the connective tissue between real-world data and smart contracts, this trend could finally unlock mainstream relevance. Its Oracle network is already being used by major financial players like SWIFT and ANZ to test tokenized settlement systems. If those pilot programs transition into sovereign-grade implementations, Chainlink could effectively become the plumbing of the new financial internet. But before any of that happens, trust has to shift. And trust is built slowly, then all at once. If there's one constant in financial history, it's that crises create innovation. When trust in the system breaks down, the next generation of systems is born. And we might be watching that cycle play out right now, with Bitcoin quietly stepping into the role gold once held, but with more transparency and fewer borders. Let's take a step back. After the 2008 financial crisis, the world turned to quantitative easing and negative rates. Central banks became the lenders of last resort, and the risk, once private, became public. Now, debt levels are past the point of easy repair. Nations can't inflate forever without eroding credibility. They can't tax more without losing voters. And they can't default without losing access to markets. That's the deadlock, and that's where Bitcoin walks in. Unlike fiat, Bitcoin doesn't bend to politics. Unlike gold, it doesn't require physical custody or central clearing. And unlike bonds, it doesn't rely on trust in a government, only in math. For emerging markets tired of being hostage to US dollar cycles, that's powerful. Because if Bitcoin is neutral money, it's also neutral collateral. Now, let's talk scenarios. Analysts at Fidelity Digital Assets recently modeled what would happen if just 5 small to mid-sized nations adopted Bitcoin reserves, equivalent to 2% of their GDP. That would translate into roughly 300,000 Bitcoin being purchased at current prices. around $17 billion worth. They projected this could increase Bitcoin's fair value by between 12% and 22% in the short term, depending on velocity and holding patterns. But more importantly, they said it could cut yield spreads on those nations' bonds by 50 to 150 basis points, meaning cheaper borrowing costs for countries willing to embrace crypto collateral. That's the kind of incentive policymakers pay attention to. Because for debt-heavy economies, access to cheaper financing isn't just helpful, it's survival. Let's add a more concrete example. Suppose Argentina, a country with a long history of defaults, decided to back a $5 billion sovereign bond with Bitcoin collateral. Even a 25% over-collateralization ratio would require $6.25 billion worth of Bitcoin held in multi-sig custody. That's about 100,000 Bitcoin. Instantly reducing supply and providing transparency no traditional bond could match. The repayment, yield, and collateral movements could all be tracked in real time by investors worldwide. That alone could attract buyers who would never touch Argentine debt otherwise. Now extend that model to Africa. Nigeria and Kenya are among the fastest growing crypto adoption hubs on the planet. If they use digital assets to back regional bonds or infrastructure financing, it would represent a paradigm shift. Money raised through crypto, secured by crypto, and spent on real-world development. And with stablecoin rails already dominating cross-border flows, the infrastructure is largely there. The big unknown is when this moves from theory to policy. And that's where geopolitics comes in. Because whether governments admit it or not, Bitcoin has already become a macro instrument. When the US sanctions a country, that nation explores Bitcoin. When China tightens capital controls, citizens turn to Bitcoin. And when global debt markets tremble, investors hedge with Bitcoin. In that sense, Bitcoin's not waiting for governments to adopt it. It's forcing their hand. Cathie Wood from ARK Invest said recently, "The moment a sovereign entity collateralizes debt with Bitcoin, we move from narrative to necessity. That's when Bitcoin becomes the world's neutral reserve asset." Her base projection puts Bitcoin at $380,000 within the next decade under that scenario. And that's without assuming major ETF inflows or corporate treasuries increasing exposure. But let's keep this grounded. Even if we see early adoption, it won't be smooth. The volatility issue remains, and no central banker wants to be the first to explain a margin call to Parliament. That's why hybrid models are more likely, collateral baskets mixing Bitcoin with tokenized treasuries, commodities, or stablecoins. This is where Ethereum and Chainlink return to the story. Because the technology that makes this secure, compliant, and auditable already exists. The World Bank's Bondi project, originally built on Ethereum, proved that sovereign debt could be issued and settled on-chain. That was in 2018, long before the current wave of institutional adoption. Now, the tools have matured. Chainlink's proof of reserve system allows any entity, including a government, to publicly verify collateral in real time. That's not science fiction. It's already live across DeFi and CeFi. All that's missing is political will. For portfolio holders, the takeaway is clear. The next wave of crypto growth may not come from new retail speculation, but from institutional necessity. As debt stress grows, as dollar dominance softens, and as nations search for new forms of credibility, digital assets will fill the vacuum. Not because of hype, but because of logic. If Bitcoin-backed sovereign debt takes off, here's what you should expect in portfolio terms. Bitcoin transitions from a high beta asset to a macro anchor. Its volatility compresses, and it starts to behave more like long-duration collateral. Think gold with yield. Ethereum captures value as the infrastructure layer of that system. The network, where the issuance, contracts, and settlements happen. Chainlink benefits as the verification layer, extracting small but persistent oracle fees as global debt becomes tokenized. And for investors holding across these three, Bitcoin, Ethereum, and Chainlink, that dynamic creates a rare opportunity, the chance to hold exposure to all layers of the emerging sovereign finance stack. But let's also be realistic. There's a time horizon to this. Sovereign finance moves slowly. Central banks don't chase trends. They follow credibility. So this won't explode overnight. It'll start at the edges. A frontier nation, a small pilot, a high-yield tokenized bond, then another, then a regional alliance like BRICS exploring Bitcoin as settlement collateral, and then, quietly, almost imperceptibly, the big players will join, because they won't have a choice. So, where are we in that timeline? Probably at step 1. But history moves fast once the incentives align. In 1998, only 2 countries used inflation targeting. By 2010, nearly 30 did. The same will happen here. Once one government successfully issues debt secured by Bitcoin, others will follow, not out of ideology, but out of competitive necessity. Michael Saylor put it bluntly last month. When a nation realizes it can borrow cheaper by using Bitcoin as collateral, it will do it. Then its neighbors will do it. Then it becomes a global standard. He's betting on a domino effect, and his company, MicroStrategy, is already positioned as a proxy play for that trend. For everyday investors, this is where strategy comes in. If you're holding Bitcoin, this is your asymmetric bet on sovereign adoption. If you're holding Ethereum, you're investing in the rails that make sovereign finance programmable. And if you're holding Chainlink, you're betting on the data integrity that makes all of it trustworthy. The risk, of course, is political, not technical. Governments can change rules overnight. Regulation can shift. Custody models can fail. That's why diversification remains essential. But the reward, if this thesis plays out, is generational. We're standing at the threshold of a new monetary era. The question isn't whether crypto will play a role in global finance. It's what kind of role it will play. And if nations start backing their debt with Bitcoin, it won't just be an asset class anymore. It'll be part of the backbone of the global financial system. So as you look at your own portfolio this week, keep this in mind. The biggest shifts don't happen in trading charts. They happen in policy papers, in pilot programs, in quiet decisions behind closed doors. Watch for the first country that issues debt tied to digital collateral, because when that happens, the game changes. Drop your thoughts in the comments, hit follow, leave a 5-star rating if you enjoyed this deep dive, and as always, we'll see you at the top.